Welcome back to the deep dive.
This time, we're focusing on something you deal with every day as FDIC examiners.
Internal controls and audits, but specifically how they work within financial institutions.
We're going deep into Section 4.2 of the FDIC's RMS Manual of Examination Policies.
It's all about sharpening your understanding of those definitions and specifics that are really the foundation of your work as examiners.
It's like a masterclass, really.
Straight from the source.
What I find really interesting is that the manual goes beyond just defining terms.
It emphasizes why those definitions matter
Exactly.
and how they connect to those real-world procedures that ensure institutions are operating safely and soundly.
All right, let's start with the most basic concept: internal control systems.
The manual defines these as the policies and procedures institutions use to reduce risks and achieve their goals.
And that covers their operating goals, reporting goals, and compliance goals.
But what's really interesting is the emphasis on the board of directors.
The manual is crystal clear about that. The board has a non-delegable responsibility for making sure those internal control programs are effective.
They're accountable.
Period.
And it's not a one-time thing.
No, they can't just set up a system and then forget about it.
The manual stresses that these programs need to be dynamic, not static.
They need to align with changes in laws and regulations.
And even the institution's own growth and how complex it becomes.
Be like a living thing, constantly adapting.
And speaking of adaptation, we need to talk about Part 364 of the FDIC Rules and Regulations.
An Appendix A to Part 364.
That's our bread and butter as examiners.
Those set those safety and soundness standards.
For internal controls, information systems, and audit programs.
And what's key here is that these standards recognize that every institution is different.
It's not a one-size-fits-all approach.
No, the controls and systems need to match the institution's specific profile.
So things like its size and the nature of its activities.
Yeah, and the scope and risk of those activities.
So it's really about tailoring those controls to the specific risks each institution faces.
Exactly. Now, the manual outlines 5 key components of these internal control programs.
And these components are essential for ensuring that the programs are effective.
Let's start with the control environment,
That's the foundation.
the bedrock of the whole system.
But what makes for a solid control environment?
Well, it starts at the top.
With the board and senior management.
They set the tone.
And the manual really emphasizes that internal controls need to be ingrained in the culture of the institution.
It can't just be a checklist that everyone ignores
They need to be genuinely valued.
and understood by every single employee,
It's about creating a culture of compliance.
and risk awareness.
But it goes beyond just culture.
The manual also gets very specific about what these control systems should aim to achieve.
So it's not just about vague goals,
Right, there are specific objectives.
like preventing or detecting what?
Things like transactions that are materially inaccurate, incomplete, or even unauthorized.
Okay, so things that could directly impact an institution's financial health.
Exactly. Then there are deficiencies in safeguarding assets, unreliable financial and regulatory reporting, and deviations from those laws, regulations, and internal policies we've been talking about.
So it's really about building a system that's proactive and reactive.
With those safeguards in place, but also mechanisms to catch things that might slip through the cracks.
Now let's move on to risk assessments.
This is where things get really granular.
Institutions have to identify and understand the specific risks they face.
It's about really examining those potential vulnerabilities.
The manual defines these as the proper identification, measurement, analysis, and documentation of an institution's significant business activities, the risks associated with those activities, and the controls they have in place to mitigate those risks.
And notice the emphasis on documentation.
Creating that audit trail.
Right. It's not enough to just have those assessments in
It
mind.
needs to be documented.
A clear record of how they identified, analyzed, and managed those risks.
That makes sense. And the manual points out that those financial risk assessments require particular attention.
Especially in a few key areas.
Okay, so for those financial risk assessments, what should examiners be focusing on?
Well, you have to think about things that could directly impact the institution's financial health.
Things like those incomplete or inaccurate transactions we talked about earlier.
Exactly. Those can lead to pretty significant financial losses.
So understanding how those errors or inaccuracies could translate into real financial consequences.
And those assessments, they shouldn't just be sitting on a shelf gathering dust.
They need to be living documents.
The manual is very clear about that.
They need to be regularly updated.
Reassess.
It's not a set it and forget it kind of
Right.
thing.
It's about staying ahead of the curve.
The manual emphasizes the importance of analyzing threats to all those significant business lines
And evaluating whether the controls are sufficient to actually mitigate those risks.
and identifying any residual risk exposures that might still be there.
Even after those controls have been implemented.
So it's about taking that proactive approach and constantly reevaluating those risks and controls.
And those methodologies they use to conduct those risk assessments, they need to be updated too.
To reflect those changes in the institution's business activities or those work processes.
Or even changes in the internal controls themselves.
So it's about making sure those assessments remain relevant.
Effective.
Now, let's talk about control activities.
These are the actions institutions take to address those risks and achieve their control objectives.
So putting those risk assessments into practice.
Exactly.
Translating those assessments into actions.
The manual defines them as the policies and procedures put in place to manage risks and ensure those predefined objectives are actually being met.
And it makes a distinction between preventative and detective controls.
Right. Preventative controls are designed to stop those undesirable events from happening in the first place.
Like having that shield in place.
Exactly. And then you have detective controls.
Those are designed to identify and address weaknesses that might have already occurred.
It's like having an alarm system that goes off if something does slip through.
So you need both to have a truly robust system.
And those control activities cover a wide range of areas.
Give us an idea of that scope. What are some examples?
Well, think about how the institution is structured,
Okay.
the composition of those committees, who has authority to approve what,
The levels of approval.
those access controls, both physical and electronic.
So who has access to what information or systems?
Then there's the design and implementation of those audit programs, how they're monitoring things, and how they take remedial actions when they find weaknesses.
And how they report those issues.
Exactly.
It really touches every facet of the institution's operations.
It's all connected.
Okay, so we've covered the control environment and risk assessments and control activities. What's next?
We'll move on to information and communication
The manual stresses that reliable information needs to get to the right people.
at the right time.
It's about having clear communication channels and making sure everyone has the information they need to do their job.
Exactly.
And it covers everything from communicating about those organizational risks and controls to sharing data about performance.
And ensuring everyone is aware of changes or updates.
Keeping everyone in the loop.
And technology plays a big role here.
Right. The manual talks about having those technology systems in place
And organizational procedures.
that help distribute those operational reports, financial reports, and compliance reports effectively.
So leveraging technology to enhance those processes.
But it's not just about pushing information out.
No, there also needs to be clear channels for reporting risks.
Or error.
Or even suspected fraud
The manual talks about procedures that enable individuals to report concerns.
through both formal and informal channels.
So it's really about creating that culture of transparency.
And accountability.
All right, and finally, we have monitoring,
It's an ongoing process.
not a one-time check.
Right. It's about making sure those internal control systems are actually working as intended every single day.
And that involves several forms of monitoring
Like those periodic control reviews.
to check the adequacy of key program components
Like the risk assessments.
and control activities.
And reporting mechanisms.
So it's like taking a deep dive into those areas.
Make sure they're functioning effectively.
But it's not just about those scheduled reviews.
No.
There are also those ongoing reviews
Of routine activities.
to ensure things are running smoothly on a day-to-day basis.
Exactly.
And having people with the right skills and authority in those key monitoring roles is really essential.
They're the eyes and ears of the whole system.
They're the ones making sure those controls are being implemented effectively.
Now that we've got a good understanding of these 5 components, we can start to get more specific about the standards institutions should be considering.
Okay, let's get granular. I'm ready.
It all starts with the board of directors establishing those appropriate control standards.
Often with oversight from an audit committee.
Ideally, that committee is made up entirely of outside directors.
So those folks who aren't involved in the day-to-day operations of the institution.
Exactly. It brings that external perspective.
That objectivity.
And one of the first controls the manual highlights is director approvals.
This might seem straightforward, but it's crucial for accountability.
Right. The board needs to set clear limits on those significant matters,
Like lending and investment authorities.
which they delegate to those committees and officers we talked about earlier.
So making sure there are clear boundaries.
And regular reports to the board, keeping them informed.
Right, so they know what's happening.
And those authority levels, along with any significant actions, need to be reviewed periodically.
So it's about ensuring the board remains engaged and informed.
Exactly.
All right, what's next?
Sound personnel policies.
This is all about having the right people in the right roles.
And making sure they're equipped to support those internal control efforts.
Building that culture of compliance from the ground up.
We're talking about thorough background checks, hiring qualified personnel, ongoing training, and those performance reviews.
Making sure everyone is competent and understands their responsibilities.
And the manual emphasizes using the FBI fingerprint check service.
And complying with the FDIC's consent requirements for folks with certain criminal convictions.
So doing that due diligence to mitigate risk from the start.
All right, let's move on to segregation of duties.
This is a classic control measure
The idea is to divide transaction processing among multiple individuals,
to reduce the risk of fraud or errors.
making sure no one person has too much control over any one process.
The manual gives a great example with loans,
Okay.
separating the approval, disbursement, and payment acceptance functions.
So no one person can manipulate the entire process.
Exactly. Checks and balances in action.
And what about those automated controls? Do those play a role in segregation of duties?
They're essential.
They can replicate those manual segregation of duties functions.
The manual talks about those automated holds placed on certain accounts.
Like those dormant accounts.
For accounts with large amounts of uncollected funds.
And those should generate exception reports, right?
Absolutely. When a hold is added or removed, or when any action requiring supervisory approval occurs, an exception report should be generated and reviewed by someone not involved in that activity.
So it's about maintaining that independent oversight even when technology is involved.
Exactly. Now, another important control measure is joint custody.
Sometimes called dual control.
Right. This is all about protecting those sensitive assets.
By requiring more than one person to be involved in their management.
Two sets of eyes, so to speak.
The manual defines it as a procedure where two or more persons share responsibility for the physical protection of specific items or records.
Making it much harder for a single individual to compromise those assets.
And the manual gets pretty specific about which items should be subject to joint custody.
It's a pretty comprehensive list.
What are some of those key items?
Well, we're talking about things like reserve cash, negotiable collateral, certificated securities, trust assets, safekeeping items, those official checks, unissued debit and credit cards, traveler's checks, and even those spare keys and combinations to those night depositories.
Wow, they really cover all the bases.
It's about reducing opportunities for manipulation.
Okay, let's talk about vacation policies.
Now, this one might surprise you.
I'm intrigued.
The manual actually recommends that banks have policies in place that require all officers and employees to be absent from their duties for at least 2 consecutive weeks, uninterrupted.
What's the thinking behind that?
Well, embezzlement schemes often require constant attention.
To manipulate those records, answer inquiries, keep things hidden.
Exactly. So forcing employees to be away for an extended period increases the likelihood that those irregularities will come to light.
It's like having those fresh eyes come in and potentially spot something that was missed before.
Exactly. Now, the manual does acknowledge that a 2-week absence might not be feasible for all institutions. So if they deviate from that recommendation, they need to establish those compensating controls.
Document those exceptions.
Right. And any significant deficiencies in that vacation policy or those compensating controls should be addressed in the report of examination.
And considered in the management component of UFIRs.
Exactly.
Okay, so what about those IT access rights? Do those come into play with vacation policies?
The manual mentions them. It suggests considering whether to suspend or restrict normal access rights during those prolonged absences.
Especially for employees with remote access.
Or high-level access.
Recognizing those unique risks.
Another control measure is rotation of personnel.
I can see how that would be beneficial.
For both training and identifying potential issues.
Exactly. The manual talks about how it enhances those internal controls and contributes to training.
And business continuity.
And it suggests that these rotations be planned by auditors and senior officers.
But interestingly, it advises against announcing those rotations ahead of time to the personnel involved.
It's about maintaining that element of surprise.
Exactly. To see how things operate when someone new steps into a role.
And those rotations should last long enough for any irregularities to surface.
Whether those irregularities are due to error or intentional fraud.
Now let's talk about those pre-numbered documents.
All about creating a clear audit trail.
The manual emphasizes using sequentially numbered instruments wherever possible.
Things like official checks, unissued stock certificates.
Even board meeting minutes.
Those minutes should be kept on pre-numbered pages.
It's about accountability and being able to trace those documents.
To make sure this control is effective, those number controls should be monitored by someone who's detached from the particular operation.
So they're independent.
And those unissued pre-numbered instruments should be kept under joint custody.
Multiple layers of security.
All right, cash controls. This is a big one for any financial institution.
Absolutely. What are some of those key controls?
Well, the manual stresses the importance of those separate cash drawers for tellers.
That they have sole access to.
And avoiding the use of common cash funds.
Because that can make it difficult to pinpoint responsibility if there are discrepancies.
Exactly. And those random cash drawer audits are essential.
Regular checks and balances.
Making sure everything adds up.
Even with the best controls, things can go wrong.
And that's where procedures for reporting irregularities and shortages come in.
Having that plan for when those uh-oh moments occur.
Management needs to develop procedures for the prompt reporting and investigation of any irregularities or shortages.
And the results of those investigations should be reported to management and internal auditors.
Regularly.
And, if appropriate, to fidelity insurers, regulators, or even law enforcement agencies.
Exactly.
Okay, now let's talk about business continuity plans.
Absolutely essential in today's world.
We've seen how important these plans are.
With everything from natural disasters to cyber attacks to pandemics.
The manual emphasizes that institutions need to have those comprehensive plans in place.
To protect their assets, safeguard their records, and minimize those operational interruptions.
It's like having that roadmap for when things go wrong.
They need to clearly define roles and responsibilities.
Right. Who's in charge of what?
They need to lay out those succession plans for different operational areas.
Just in case.
And they need to include procedures for testing and updating those plans regularly.
So they need to be living documents.
Constantly evolving.
And don't forget about training.
Employees need to know what to do if there's a disruption.
Makes sense. The manual recommends that those plans be reviewed at least annually.
By independent auditors.
Either internal or external.
To make sure they're up to date and actually effective.
So it's not just about having a plan, it's about making sure it's actually a good plan.
And that it's understood by everyone.
Okay, now let's talk about accounting systems.
This is foundational.
It's like that saying, garbage in, garbage out.
Exactly. Institutions can't operate effectively without record-keeping systems that generate reliable information.
If the information isn't accurate, the decisions made based on that information won't be good.
The directors need that information to stay informed.
And officers need it to manage effectively.
And accurate records are also essential for meeting the needs of customers, shareholders, those supervisory agencies, and the tax authorities.
They really underpin everything.
Those accounting systems should be designed to make it easy to prepare those internal reports.
The ones that correspond to the responsibilities of those individual supervisors and employees.
Right. And those records should be updated every day.
To reflect each day's activities.
And those subsidiary records, for things like deposits, loans, and securities, they need to balance with those general ledger accounts.
So everything needs to line up.
It's all about accuracy and consistency.
And those records should be kept following well-established accounting and banking principles.
Transparency is key.
So, making sure the information reflects the reality of the institution's financial condition.
And its operating results.
The manual specifically mentions the audit trail.
That's crucial.
For maintaining accountability and transparency.
The record-keeping system should be designed so that any transaction can be traced.
Like following the money.
You should be able to see how it moved through the accounts.
The manual lists some common deficiencies that examiners have seen with these records.
It's a good checklist to keep in mind during those reviews.
Okay, what are some of those red flags?
Outdated general ledger entries that lack descriptions.
So you don't know what those entries represent.
Customer loan records that are inaccurate or incomplete.
Or even missing entirely.
Then there are those deficient cash item, overdraft, and suspense account records.
So those are guys that can be more prone to manipulation.
Then you have inadequate teller cash records, security registers that lack key information, those outdated correspondent bank account reconciliations that are missing details, and account overage or shortage descriptions that are vague or incomplete.
It sounds like attention to detail is crucial.
It really is. And then there are those issues with inadequate letters of credit or contingent liability records.
And those inter-office or inter-branch accounts that aren't properly controlled or monitored?
Covering all the bases.
Okay, so it's really about dotting those I's and crossing those T's when it comes to record keeping.
Now, another thing the manual highlights is the accounting manual.
It's about establishing those clear guidelines.
To ensure transactions are processed and recorded correctly every time.
So regardless of who's handling those transactions, the process is consistent.
Precisely. The manual suggests that management establish those accounting manuals
And data processing guides.
to help employees handle those transactions consistently.
It might include things like instructions for preparing and reconciling those source documents, processing them internally, sending them to a service provider for processing, and distributing those output reports,
Exactly.
outlining those procedures step by step.
To minimize those errors.
Whether an institution processes those transactions internally or uses a service provider, it's crucial that they have clear instructions for recording those transactions and controlling how those documents and data move between the customer, the bank, and any data processor.
It's about establishing a chain of custody.
Maintaining accountability.
Exactly.
All right, we've covered a lot of ground here, setting the stage for understanding these internal controls.
Yeah.
What's next on our agenda?
Let's delve into the world of audits.
Both internal and external audits play a crucial role in ensuring those institutions are operating safely and soundly.
We'll explore each of them in detail, along with what you, as examiners, should be focusing on during your reviews.
I'm looking forward to it,
We touched on this earlier, but internal control and internal audit, those are related.
but different.
Exactly. Internal control, those systems, policies, procedures, they're all about managing risks, protecting assets, and achieving objectives, but internal audit.
Well, that helps the directors and those officers evaluate how effective those systems actually are,
It's an independent check.
on whether those controls are actually doing what they're supposed to be doing.
When having a strong audit program,
Ideally, one that incorporates both internal and external audits.
that can really reduce those financial and operational risks.
So let's start with internal audits. What are those general standards the manual talks about?
Well, Appendix A to Part 364, it lays out the general standards for internal controls, information systems, and audit programs. And when it comes to those internal audit programs specifically,
They need to be appropriate for the institution.
for its size and the activities they're engaged in,
There's that tailoring concept again.
making sure the program fits the institution.
So what are some of the specifics?
Well, they should provide for a few key things. First, adequate monitoring of that internal control system.
To make sure it's actually working.
Then you have independence and objectivity.
The auditors need to be able to do their job without being influenced.
Exactly, to maintain the integrity of that whole process.
And what about the people doing the audits?
You need qualified personnel.
They need the right knowledge and skills,
Absolutely. And adequate testing and review of information systems.
especially with all the technology used in banking these days.
And all of that work needs to be documented.
Creating that audit trail,
Those test findings, any corrective actions taken, it's all about having those records.
and then verifying and reviewing whether management actually addressed those weaknesses that were found.
Not just finding the problems, but fixing them.
And who oversees all of this?
The audit committee or the board of directors, they need to review how effective that internal audit function is,
So it's like layers of accountability.
making sure the oversight is working.
Now, the manual mentions a policy statement from 2003.
The interagency policy statement on the internal audit function and its outsourcing.
It sounds like it provides some good guidance for examiners.
It really does. It talks about the board and management's responsibilities, what makes an internal audit function effective, specific things to consider for those smaller institutions and those outsourcing arrangements.
They're becoming more common.
It also addresses those independence considerations when you have external auditors also doing internal audit work.
Trying to avoid those conflicts of interest.
And it talks about those independence requirements that are different for public versus non-public companies.
So there's some nuances there,
And then there are those annual audit and reporting requirements.
which are often tied to the institution's size.
And of course, those examiner reviews of those internal audit functions.
Sounds pretty comprehensive.
It covers a lot of ground now. Those directors and that senior management, they need to be reasonably sure that their internal control system is working.
Preventing or detecting those issues we talked about earlier.
Those inaccurate or unauthorized transactions, those deficiencies in safeguarding assets, unreliable financial reporting, and those deviations from laws, regulations, and internal policies.
It's a lot of responsibility.
It is, and to help ensure that internal audit program is appropriate for what the institution is doing and planning to do, the manual suggests looking at those professional standards.
Like the ones from the Institute of Internal Auditors.
The IIA, they have their standards for the professional practice of internal auditing.
Provides a good benchmark.
Those standards cover things like independence, professional proficiency, the scope of the work, how it's performed, how those audits are managed, and quality assurance reviews.
So it's really about raising the bar for internal audits.
Making sure they're effective and professional.
Now, the manual also talks about some functional characteristics that are important for an effective internal audit function.
Things like the organizational structure,
How those teams are managed and staffed.
the quality of the audits themselves, the scope of the work, how they communicate their findings, and those contingency plans.
So it's like a blueprint for a well-run program.
Let's dig into those a bit more. Starting with that organizational structure, the manual explains that the internal audit function needs to be set up in a way that gives the board confidence.
Confidence that those auditors can be impartial.
Exactly. They shouldn't be unduly influenced by management.
So maintaining that independence is really important.
And ideally, that audit committee oversees the internal audit function,
They evaluate their performance,
and they decide who's responsible for that function.
whether it's an internal audit manager or another member of management.
So a clear chain of command with the audit committee at the top.
And if the responsibility is assigned to a member of management,
That individual shouldn't be involved in those day-to-day operations.
so they're not auditing themselves,
Ideally, that internal audit manager reports directly to the audit committee.
about any audit issues or administrative things like budgeting and compensation.
So they have that direct line of reporting to maintain that independence,
Now, I imagine there are situations where you have a dual reporting structure,
where the internal audit manager reports to both a senior officer and the audit committee.
which could streamline some things, but might increase the risk of compromising that independence.
You're right, and the manual acknowledges that
It's a balancing act.
the board needs to weigh the risk of that diminished independence against any potential benefits.
So it's a judgment call?
If they do decide to go with that dual reporting structure, they need to document their reasoning.
So transparency is important.
And they need to outline those controls they have in place to make sure that audit independence is maintained.
Demonstrating that they've carefully considered the risks.
Now, let's talk about management staffing and audit quality. The internal audit manager plays a big role here.
What are they responsible for?
Those control risk assessments, developing the audit plans, putting together those audit programs, and generating the audit reports.
So they're really at the helm of that internal audit process.
Those control risk assessments are really important.
Why is that?
They document what the auditor understands about the institution's activities.
And the risks involved.
They typically analyze those inherent risks in each activity, look at those control processes, and identify any residual risks.
So it's about understanding the whole risk landscape.
Those internal audit plans are built on the findings from those assessments.
So it's all connected.
Those plans summarize those key internal controls, lay out the timing and frequency of that planned work, and include a budget.
So it's like a roadmap.
Then you have those audit programs themselves.
Just outline what needs to be done.
They describe those audit objectives and list out the procedures for each review once the audit work is complete.
Then you have the reports,
They present the purpose, scope, and results of the audit.
including any findings, conclusions, and recommendations
All of that work is documented in work papers.
to support those findings.
Ideally, that internal audit function, that's their only role.
To evaluate and report on the effectiveness of the institution's risk management control and governance processes.
Independently and objectively.
So staying focused on that core function.
They shouldn't be involved in things like approving or implementing operational policies.
Which could create conflicts of interest.
The audit committee needs to make sure that any consulting type work done by that internal auditor,
Like advising on mergers or new products.
that it doesn't interfere with their objectivity when they're monitoring those internal controls.
Maintaining those clear boundaries.
And to make sure those audits are high quality, you need the right people in those roles
People with the expertise to do the job.
to identify those operational risks and assess whether those controls are actually working.
The manual mentions that those policies, procedures, and work programs need to be commensurate with the internal audit department and the institution itself.
Right. Aligning those resources with the needs.
Now let's talk about the scope of that internal audit work. How much are they actually reviewing?
Well, the manual says that the frequency and extent of those reviews and testing should align with the nature, complexity, and risk of the institution's activities.
So not just looking at the balance sheet, but those off-balance sheet activities as well.
Taking that holistic view of the risks.
And who's responsible for making sure that scope is appropriate?
At least annually, that audit committee needs to evaluate and approve that control risk assessment, the scope of those audit plans, and how much the audit manager is relying on outside vendors.
So making sure they're staying on top of things.
They also need to periodically review whether that internal audit function is sticking to those approved plans,
And if they find any issues.
or if there are changes to the institution's structure, activities, or risks.
They might need to expand that internal audit work.
Being flexible and responsive.
Now, I imagine for smaller institutions, those costs of having a full-time audit manager or a dedicated staff might be a challenge.
The manual acknowledges that it might not be feasible for those smaller institutions that have less complex operations and lower risk profiles.
But they still need some form of internal audit function.
Right, absolutely. They can still have those objective reviews of their significant internal controls.
Finding a way to make it work, even with limited resources.
To make those reviews effective, you need competent people to design those procedures.
And whoever's doing those reviews can't be responsible for the controls being reviewed.
Back to that independence and objectivity.
The findings from those control reviews, they should be reported to the audit committee.
And then it's up to them to make sure management takes action to correct any deficiencies.
Working together to address those issues.
Now, communication is really important.
Especially when it comes to identifying and fixing those weaknesses.
Those internal auditors need to be able to openly discuss those weaknesses with management.
And any proposed solutions.
And any significant matters should be reported directly to the board or that audit committee.
Keeping everyone informed.
And it's important for those auditors to have the opportunity to talk with the board or audit committee without management being present.
Creating that safe space for open and honest conversation.
Institutions should also have procedures for employees to report concerns about accounting control or auditing matters.
Allowing for both confidential and anonymous reporting.
Empowering employees to speak up.
The next functional characteristic is contingency planning.
Having a backup plan.
In case something disrupts that audit process.
Whether they use in-house staff or an outsourced arrangement, they need a plan to address any discontinuity in that internal audit coverage.
Especially for those high-risk areas.
Speaking of outsourcing, the manual talks about that in some detail.
What are some of the key things about those arrangements?
Well, they involve contracts between the institution and a vendor who provides those internal audit services.
So a third party is doing the work.
Exactly. And those arrangements can vary.
They can handle a small portion of the audit function or a much larger portion.
It's a flexible model, but even when they're outsourcing, the institution's directors are still ultimately responsible
for maintaining those internal controls and audit programs.
That accountability doesn't go away just because they're using a vendor.
Right. They need to make sure those vendors are up to par.
And to make sure everyone is on the same page, they should have a written contract.
Or an engagement letter.
That clearly outlines the duties of both the institution and the vendor.
Avoiding any confusion or disagreements later on.
The manual lists several provisions that are typically included in these contracts.
Okay, what are some of those key things they cover?
They need to clearly define those expectations and responsibilities for both parties.
Who's doing what?
And they should set the scope, frequency, and fees for that vendor's work.
So those logistical details are outlined up front.
And they should describe those communication protocols.
How they're going to share information and reports about the progress of the work?
Open communication is key. And there should be a process for changing the terms of that contract.
For example, if they need to expand the scope of the audit work.
So having that flexibility.
And what about those audit reports and work papers? Who owns those?
The contract should clearly state that those reports are the property of the institution.
So the institution retains ownership.
And that those designated employees will have access to those work papers.
And they can get copies if they need them.
It should also specify where those documents are kept.
And how long the vendor has to keep them.
Those record retention requirements.
And it should state that those vendor-conducted audits are subject to review by regulators.
And that examiners will be granted access to those reports and work papers.
So transparency and acknowledging that oversight is still in place.
Exactly. And they should outline a process for resolving disputes.
What if there's a disagreement?
And for determining who's responsible for covering the costs of any damages.
From errors or negligence.
So having a plan for those what-if scenarios.
And what about the vendor's role? What can't they do?
The contract should state that they won't be performing any management functions,
making decisions, or acting like an employee.
maintaining those boundaries.
And they need to comply with those independence guidelines.
From the AICPA, the SEC, the PCAOB, or any other relevant regulatory agencies.
So following those professional standards.
And it's important for management to do their due diligence when they're selecting those vendors.
Not just picking the first one they come across.
They need to carefully evaluate them and then periodically review the vendor's performance.
So staying involved throughout the process.
Making sure those vendors are meeting their expectations.
Now, what about communication? Does that change when you're outsourcing?
It shouldn't. That open communication between the internal audit staff, the audit committee, and senior management needs to continue.
Even when they're using a third party?
Those control weaknesses should be reported to that internal audit manager.
And if they decide not to report those findings to the directors or senior management?
That should be a mutual decision.
Between that manager and the vendor.
And when they're deciding which issues to bring to the board's attention, that concept of materiality.
Like they use in financial statement audits.
It might not always be the best way to decide.
So what should they focus on instead?
Well, for example, when you're looking at compliance with those laws and regulations, even those small exceptions could be important.
So it's about using judgment and looking at the bigger picture.
Another consideration is accountant independence.
Avoiding those conflicts of interest.
The manual explains that accounting firms can potentially compromise their independence if they're doing both internal and external audit work at the same institution.
So wearing two hats.
The Sarbanes-Oxley Act, it actually prohibits that for public companies.
They can't have the same firm doing both.
For those non-public institutions, they're encouraged to think carefully about those risks.
Weighing the potential cost savings against that compromised independence.
All right, now let's talk about those external audits.
The ones done by an independent outside firm.
They should be designed to make sure those financial statements are prepared according to GAAP.
And to alert management to any deficiencies in those internal controls over financial reporting. So having that independent verification of those financial statements and an assessment of those internal controls.
Exactly. Now, Section 36 of the FDI Act and Part 363 of the FDIC Rules and Regulations.
They lay out those audit and reporting requirements.
For institutions with total assets of $500 million or more.
So those larger institutions.
And for those institutions with less than $500 million?
There's a policy statement from 1999.
The Interagency Policy Statement on External Auditing Programs of Banks and Savings Associations.
So guidance for both larger and smaller institutions.
And if those examiners find any weaknesses in those programs,
they should make recommendations
in their report of examination.
Okay, let's talk about audit committees. What does the manual say about those?
They strongly encourage all banks to have an audit committee.
Made up entirely of outside directors.
Those independent folks.
Avoiding conflicts of interest.
Now, they do acknowledge that it can be difficult to do that in a small, closely held bank.
Especially those smaller institutions.
But they still encourage all banks to try to include those outside directors.
On their board and on that audit committee.
Striving for that best practice, even if it's not always easy.
So at least annually, that audit committee or the board, they need to analyze the scope of that external auditing coverage.
Making sure it's appropriate for the bank.
Because it's not a one-size-fits-all.
They need to consider the size, the complexity of those operations, and the potential benefits of having those financial statement audits, internal control reviews, and additional procedures for specific periods or those high-risk areas.
So tailoring that coverage to the bank's specific risk profile.
Exactly. And any decisions they make about that coverage.
They need to document their reasoning.
In those committee or board meeting minutes.
Demonstrating that thought process.
And if those examiners determine that there are risks that need additional auditing.
They should make specific recommendations.
To address those concerns.
So it's a collaborative process.
Working together to ensure that coverage is adequate. Now, let's talk about those external audits of financial statements.
Having those statements reviewed by an independent firm.
The manual points out that these audits can be really helpful for those boards.
When it comes to meeting their responsibilities.
And providing assurance that those financial reports are accurate and complete.
That extra layer of confidence.
And those audits can benefit management as well. They can give them insight into how effective those accounting and operating policies are, those internal controls, their internal audit program, and even those management information systems.
So it's not just about compliance, it's also about improvement.
Exactly. The manual encourages banks to adopt an external audit program.
That includes those annual audits of their financial statements by an independent public accountant.
unless those statements are included in the audit of the parent company's consolidated financial statements.
So that's generally the preferred approach.
If they do that, they're generally considered to have met the objectives of that 1999 interagency policy statement we talked about earlier.
Okay, so let's talk about those external audit reports. What are some of the key things for examiners to keep in mind?
Any state non-member bank that has external auditing done, no matter the scope of that work, they should send a copy of those reports to the appropriate FDIC regional office,
Including those management letters.
keeping the regulators informed.
If they're combining those state-required procedures with additional procedures,
They can submit a copy of the auditor's report on both.
packaging those reports together.
The FDIC also wants to know when a bank hires a new public accountant or auditor, or if there's a change in accountants,
They need to be notified promptly.
within 15 days.
Transparency in communication.
And if they're using an alternative program,
Instead of that annual audit of the financial statements,
that report they produce should describe the procedures they performed.
providing that clarity.
And if that report says they performed procedures agreed upon with management,
They should provide a copy of that engagement letter.
or any other documentation that outlines those agreed upon procedures.
So the FDIC can assess whether the scope of that program was adequate.
Now let's talk about audits at those institutions with less than $500 million in assets.
Those smaller institutions.
Regulators consider that annual audit of financial statements by an independent public accountant to be the best type of program.
The gold standard.
But those smaller institutions, they might be able to use some alternative methods.
Which might be required by state laws.
So there could be some flexibility there.
What are those alternative options?
One option is having an independent public accountant report on the institution's internal control structure over financial reporting.
So instead of auditing those financial statements, they're looking at the controls.
Exactly. They examine and report on management's assertion about how effective those controls are.
Sounds less expensive than a full audit.
It often is, especially for those smaller institutions with less complex operations, and it should include recommendations for improvement.
Suggesting ways to strengthen those controls.
And those assertions and attestations should generally cover lending and investing activities.
Because those tend to have the most significant risks.
Another option is a balance sheet audit.
Focusing just on the balance sheet.
It's done according to GIS, but it doesn't look at the income statement of changes in equity or the statement of cash flows.
So a more limited scope.
It often costs less, but it doesn't provide as complete a picture.
What's another option?
Some smaller institutions can utilize those agreed-upon procedures for state-required examinations.
So aligning with those state requirements.
Some states require those specific procedures to be performed annually.
By the directors or other independent individuals?
It could be less expensive than a full audit, depending on the scope. But that auditor isn't reporting on the fairness of the financial statements or attesting to the effectiveness of those internal controls.
So it's a different type of assessment.
Their findings are presented to the board or audit committee so they can decide what those findings mean.
Now, if the board or audit committee decides not to do an annual audit,
They need to document their reasoning.
in those meeting minutes,
And examiners should make sure that alternative program is appropriate.
that it covers those high-risk areas and is done by a qualified auditor,
If there are any weaknesses, they should comment on them in the report of examination.
playing that oversight role.
If a bank with less than $500 million in assets decides not to have an annual audit,
Those examiners should encourage them to reconsider,
to engage an auditor for an external audit.
even if they have a strong internal audit program.
It's not usually a good enough reason to skip that external audit.
Those two programs should complement each other.
The external audit is often testing the strength of those internal controls and that internal audit program.
Making sure those are actually working.
So in those cases where they don't have that external audit, examiners should talk with the board
About the benefits.
and recommend that they reconsider their decision.
Okay, so now let's talk about those institutions with $500 million or more in assets.
All institutions should have good audit programs, but those larger ones,
They're required to comply with Part 363.
they have to have those external audit programs.
The higher bar.
They have to prepare those financial statements, produce those annual reports that detail management's responsibilities, and assess compliance with laws and regulations, and make sure those reports are signed by the right people.
Sounds pretty comprehensive.
It's about accountability and transparency. Those financial statements have to follow GAAP and be audited by an independent public accountant.
Okay, what about those annual reports? What needs to be in those?
A statement of management's responsibilities.
Okay, what are those responsibilities?
Preparing those financial statements, maintaining a good internal control structure and procedures for financial reporting, and complying with those laws and regulations.
So outlining those key areas.
And they need to include a statement about whether the institution complied with those applicable laws and regulations and disclose any instances where they didn't comply.
So being upfront about any issues.
Those management reports for institutions with $1 billion or more in assets.
They have some additional requirements.
They have to provide an assessment of how effective their internal control system is and identify that internal control framework they used to indicate whether they considered controls during that assessment, express their conclusion about whether that internal control over financial reporting is effective, and disclose any material weaknesses that weren't fixed.
A much deeper dive into those controls.
Now, who signs those management reports?
That depends.
If those financial statements and management reports are prepared at the institution level,
Then who signs them?
the CEO and either the chief accounting officer or the CFO of the institution.
Making sure the right people are signing off.
If the financial statements are prepared at the holding company level,
And the management report is prepared at that level as well.
then the CEO and either the chief accounting officer or CFO of the holding company sign it.
Aligning those signatures with the level of the report.
And if those financial statements are prepared at the holding company level, but the management report is prepared at the institution level,
Or if parts of it are prepared at each level.
then the CEO and either the chief accounting officer or the CFO of both the holding company and the institution need to sign it.
So it gets a little more complicated in those situations.
They need to be clear about what level each part of that report is being satisfied at.
Clarity and transparency for those regulators.
Okay, now what about the responsibilities of those independent public accountants?
The ones doing those external audits for institutions covered by Part 363.
They have to audit and report on the financial statements.
Making sure they're in accordance with either GAA's or PCAOB standards.
And for institutions with $1 billion or more in assets,
They have some additional responsibilities.
they examine, attest to, and report separately on those management assertions about the institution's internal control structure and those procedures for financial reporting.
So they play a big role in ensuring the accuracy and reliability of the information.
Part 363 also lays out those reporting requirements.
What are some of those key requirements?
First, they have to submit that annual report.
And when is that due?
For public institutions, it's due 90 days after their fiscal year end. For others, it's 120 days.
So a bit longer for those non-public institutions.
And when required, that report has to include those audited financial statements, the audit report, those management statements and assessments, and the accountant's attestation about that internal control structure.
A whole package of information.
Then within 15 days of getting them, they have to submit any management letter, the audit report, any qualifications to the audit report, and any other reports,
Including those attestation reports.
keeping those regulators informed.
And they have to notify the FDIC when they engage a new accountant, or when an accountant resigns or is dismissed.
Within 15 days.
Again, that transparency and communication.
And if they can't meet a filing deadline,
They have to submit a notice of late filing,
by the filing deadline.
letting the FDIC know why they can't file on time and when they expect to file.
Now, Part 363 also has those requirements for those independent public accountants.
Okay, what are those?
They need to have had a peer review or be in a peer review program.
Before they can start providing services under Part 363.
It's about making sure they're subject to those quality reviews.
And they have to notify the FDIC and the appropriate federal banking supervisor when they stop being the accountant for an institution.
Yeah.
That communication piece, again.
Now, those audit committees for those institutions that fall under Part 363, as we mentioned earlier, those institutions, they're required to have that audit committee.
Composed of those outside directors.
They have to be independent of management. Their job is to oversee that internal audit function, select the accountant, and review what the audit covers and what it found with both management and the accountant. They also look at those management assertions and accountant attestations.
So a pretty big oversight role.
They do, and for those institutions with more than $3 billion in assets.
The really big ones.
Part 363, it adds some more requirements for those audit committees.
What are those extra requirements?
At least 2 of the members of that audit committee, they need to have expertise in banking or something similar, like financial management.
So they know what they're looking at.
And those big customers of the institution, they can't be on that committee.
Makes sense to avoid conflicts of interest.
That audit committee also needs to be able to talk to their own lawyer.
Their own outside counsel.
It's all about making sure that audit committee has what they need to do their job right, the expertise and the independence.
Now, what about those holding company subsidiaries?
Regardless of how big they are, those
The
subsidiaries,
one covered by Part 363.
they can actually file those audited, consolidated financial statements of their holding company.
Instead of separate audited statements just for the institution.
So they might be able to streamline things a bit.
And those subsidiaries with less than $5 billion in assets.
They can choose to comply with those other Part 363 requirements at the holding company level.
So relying on the holding company's structure and processes.
As long as that holding company is doing things that are comparable to what the institution itself is required to do.
Makes sense. Those functions need to be handled somewhere.
And if that's the case,
If the holding company is doing those comparable things
then that subsidiary can rely on the holding company's audit committee,
and can file those reports and attestations that were prepared for the holding company.
potentially simplifying things.
Now, those subsidiaries with $5 billion or more in assets.
They can also choose to comply with those requirements at the holding company level.
But there's an extra condition,
That holding company needs to be doing those comparable things.
like we just talked about.
And that institution also needs to have a composite CAMELS rating of 1 or 2.
So they need to be in good shape from a regulatory perspective.
Now, that audit committee for that subsidiary,
It can be made up of the same folks as the holding company's audit committee.
they can share members, but those individuals have to be outside directors of both the holding company and the subsidiary.
And independent of management for both.
So it's about maintaining that independence at both levels.
Now, if the institution being examined isn't the lead bank in that holding company structure,
That examiner needs to confirm a couple of things.
who are those?
That the institution qualified for that holding company exemption and that they actually used it.
So making sure everything is in order.
And they need to look at those holding company reports to see if there's any important information about that subsidiary.
Making sure there's no missing information. Okay, now what about mergers? What happens when institutions merge?
If an institution is covered by Part 363 and it merges with another institution,
And it stops existing at the end of the fiscal year?
it doesn't have to file reports under Part 363 anymore.
So that merger relieves them of those reporting obligations.
Now, if that merger happens after the fiscal year ends but before the filing deadline,
It gets a little trickier.
they should talk to the FDIC's Accounting and Securities Disclosure section
And their primary federal regulator,
to figure out what they should do about those reports.
getting clarification from the regulators.
Now, what about reviewing compliance with Part 363? What should examiners be looking for?
Where should they focus their attention?
When they're looking at that audit report,
From the independent public accountant.
they need to look closely at any qualifications in that opinion and any unusual transactions. And when they're looking at both management's report and the accountant's attestation, they should pay attention to any assessments that suggest there might not be effective internal controls over financial reporting, or that there's less than material compliance with those laws and regulations.
Looking for those red flags.
Exactly, and those notices about changes in accountants.
The institution needs to submit those.
They should be reviewed to see if the institution might be trying to get a more favorable opinion and to see if there are any other safety and soundness concerns.
So understanding a reason for the change.
And they should review the board's determination that those audit committee members are independent
From the institution's management.
for institutions with more than $3 billion in assets.
The really big ones.
The examiner needs to check those board minutes and make sure they show that at least 2 members of that audit committee have that expertise we talked about,
In banking or financial management.
and that none of them are big customers of the institution.
Avoiding those conflicts of interest.
If any of those things don't seem reasonable,
They should make recommendations in the report of examination.
and during the first exam of an institution covered by Part 363,
So that initial review.
those examiners, they should talk to both management and the board about any violations they see.
So starting off with that conversation.
They should focus on educating those folks and making recommendations for how to comply in the future.
Getting them on the right track.
And that report of exam should say where the institution is in terms of complying with the rule.
If they're not fully compliant yet.
Now, if examiners have concerns about an accountant or firm's auditing attestation or accounting practices,
That might require looking at those peer reviews.
they should talk to the regional accountant
Escalating those concerns.
and those peer review work paper evaluations.
Where they actually look at those work papers.
They're usually only done in those really unusual or serious situations.
Not something that happens every day.
No, examiners shouldn't be giving written opinions about Part 363.
To the institutions or those auditors.
If they get questions, they should refer them to the regional accountant.
Okay, let's move on to those other external audit issues. What about communicating with those external auditors?
The 1992 Interagency Policy Statement on Coordination and Communication between External Auditors and Examiners.
That's a mouthful.
It outlines those guidelines for those meetings between those folks.
So examiners and external auditors.
The FDIC wants those examiners and those auditors to communicate.
But they need permission from the institution's management.
It's a collaborative process.
And when is that permission considered to be given?
Once the institution tells the FDIC who they've hired as their external auditor,
So that notification acts as the green light.
and that permission stays in effect.
Unless the institution says they're no longer working with that auditor or they've hired someone new.
The FDIC wants those auditors to be at those exit meetings.
And any other discussions about the exam findings?
Promoting that open communication
Now, those auditors can also request a meeting.
with any of the regulators to talk about those supervisory matters.
So if they have concerns, they can reach out.
If they want to talk to the FDIC about an exam, they should contact that regional office, and someone from the regional office, they can talk to that auditor about those findings.
So those auditors can get clarification
And those regulators, they usually want management to be there.
at that meeting.
But the auditor can request to meet without management.
So they have that option.
Those requests can also come from the regulators themselves,
So the examiners can reach out to the auditors
if they have questions.
about things that the auditor might know about.
They might want to ask for copies of those work papers related to the auditor's work.
Getting as much information as possible
Now, sometimes someone from the FDIC might want to be at that meeting.
where the audit report is discussed.
With management or the board,
They should let the institution know.
and ask them to pass that request on to the auditor.
So going through the proper channels?
That 1992 policy statement, it encourages that open communication and sharing of information.
And what kind of information are we talking about?
Things like those reports of condition examination reports, regulatory correspondence, and any agreements or actions.
So giving those auditors a better understanding of the institution's regulatory standing.
And the AICPA, they have guidance that says those auditors should be talking to examiners.
What does that guidance say?
It says those auditors should look at those communications from examiners and ask the examiners questions if they need to, and they should be open to examiners attending those meetings between the auditors and the bank's management.
So it's about working together.
And if management doesn't want the auditors to see that regulatory material or talk to examiners, that could be a problem.
It could prevent the auditor from giving an opinion.
Now let's talk about work paper review procedures.
What are those all about?
Examiners might review those work papers from the external audit.
For institutions or holding companies?
They'd do this in consultation with that regional accountant.
Those work papers, they can be really helpful for examiners.
Looking at those work papers can help them figure out what to focus on during the exam,
They can see where the audit was really thorough.
and maybe reduce the work they need to do in those areas,
And they can also see those higher risk areas.
where they might need to do more work.
So using those work papers to make the exam more efficient.
And those work paper reviews can be especially helpful if the institution has certain issues.
Like what kind of issues?
Things like asset quality problems, complex investments, aggressive accounting practices, mortgage servicing activities, or those big deferred tax assets.
So situations where there might be more risk.
Before starting a work paper review,
Examiners should coordinate with other regulators,
like the state bank supervisor and the primary federal regulator,
and they should coordinate with regulators for the holding company and any subsidiaries too.
it's about making sure those work papers aren't being reviewed multiple times.
So avoiding duplication of effort. Now, are there specific situations where examiners should always review those work papers?
There are two main situations.
Okay, what are those?
If there are significant concerns about things covered by that external audit, and if the institution has a UFIRS composite rating of 4 or 5.
So if there are red flags or the institution is in trouble.
Now, even in those situations, they should use their judgment.
About whether that review will actually be helpful.
If they decide not to do it,
They need to document their reasoning.
in those work papers.
Now, if the regional director wants to see those work papers, what's the process?
They need to send a written request.
That's pretty standard.
It needs to say which institution they want to review it, should say that they want to see the accountant's policies and procedures, and it should ask for someone from the accounting firm who knows about the institution to be available.
To answer questions.
Those work papers, they can be huge.
Lots of information.
So examiners should review them at the firm's office.
And because those work papers are confidential?
They should take notes and only ask for copies of the documents they really need.
Okay, so now let's talk about complaints against accountants.
If an examiner thinks a CPA or a licensed public accountant might have violated those professional standards,
What should they do?
they should talk to the accountant about it.
Trying to resolve it informally
If they can't, they should send a memo to the regional director,
with a copy to the regional accountant.
outlining the issue and explaining why they couldn't work it out with the accountant.
So taking it up the chain
And if they decide to file a formal complaint,
about those violations.
they'll send letters to the State Board of Accountancy, the AICPA's Professional Ethics Division, if it's a CPA, the accountant or a firm themselves, and the RMS Accounting and Securities Disclosure section.
Letting everyone know.
And those complaints, they can also cover things like poor audit work or a lack of independence.
So it's not just about those ethical violations.
It's also about the quality of the work.
Now, what about those third-party audits that are done at the FDIC's request?
Sometimes examiners might find that an institution is doing things,
That management doesn't have the expertise to handle,
like if they have complex financial instruments on their books,
or internal control problems.
that needs an outside expert to fix in those cases, they can ask the institution to hire someone
To do a specific task.
after getting the right approvals.
And this wouldn't be part of that normal external audit program.
It's about bringing in those specialists.
Now, if that work is done by an independent public accountant,
It could fall under a few different types of engagements.
like what?
Agreed upon procedures, special reports, or reports on the application of accounting principles.
So different ways to structure those engagements.
Those special reports and those reports on the application of accounting principles.
They're done under GAS or PCAOB standards.
But those agreed upon procedures,
They're done under different standards.
generally accepted standards for attestation engagements.
Or GASA.
And if they hire a different type of professional,
Not an accountant.
they might have to follow different standards.
But the important things for that examiner to think about when they're looking at that contract with that professional,
They're pretty similar.
regardless of who's doing the work.
Now, if the FDIC does require an institution to hire someone to do a specific task,
The regional office should look at that contract
before they sign it to make sure it describes the work clearly.
so that professional knows what's expected.
And that contract or engagement letter should include a few things.
What are those essential elements?
A description of the work, the responsibilities of that professional, a list of those specific financial statement items the work is supposed to be done, on who's responsible for recording them, and what the basis of accounting is.
So laying it all out.
And it should reference the right professional standard.
Whether it's auditing attestation or appraisal standards.
And it needs a section that describes those procedures that need to be done, any specific sources of information they should use, what the qualifications are for those employees who are doing that work, the time frame for finishing the work, any restrictions on how those findings can be used, and it needs to say that examiners can access those work papers,
It's pretty detailed.
making sure everyone is on the same page.
Okay, now let's talk about the Sarbanes-Oxley Act of 2002.
SOX. I've heard of it, but remind me, what's its main purpose?
It was put in place to protect investors from companies that are cooking the books.
So preventing those accounting scandals?
It focuses on financial disclosures and requires management and auditors to have those internal controls in place and report on whether they're good enough. And it mostly applies to those companies that have securities registered with the SEC or a federal banking agency.
So not all institutions are covered.
For those FDIC-supervised banks that have registered securities
Those public companies,
or are subsidiaries of public companies, they have to follow SOX.
including all those rules about audit standards, management responsibilities, and financial disclosures.
Now, those non-public banks,
They're generally not covered by SOX,
but there are other rules that have similar requirements.
like Section 36 of the FDI Act and Part 363.
And even though it's not required,
For those smaller non-public institutions, the FDIC encourages everyone to use those best practices when it comes to accounting internal controls and reporting.
as much as they can given their size and risk profile.
Those banks with $500 million or more in assets,
At the start of their fiscal year.
they have to follow those audit and reporting requirements in Part 363.
And sometimes they can meet those requirements by submitting those consolidated financials from their holding company.
Just so there's some flexibility.
And those key requirements include preparing those annual financial statements according to GAAP that are audited by an independent accountant, and those annual management reports that have a statement of management's responsibilities for preparing those statements, keeping a good internal control structure, and following those laws and regulations, and management's assessment of the institution's compliance with those laws and regulations.
So it's a pretty comprehensive package.
Now, what about evaluating those audit programs as an examiner?
Examiners need to look at those audit and control procedures.
To get a sense of how strong that internal control program is.
And every bank is different, so they need to use their judgment and consider things like the institution's risk profile size, complexity number of employees, things like that.
So tailoring their approach to the institution.
And if they find a lot of problems with those controls,
Or if there's serious problems,
they should mention them in the ROE, but they should only make recommendations for corrective actions after considering a few things.
like what?
Those recommendations should make sense. They should explain how the bank would benefit from implementing them, and they should talk about them with management before going to the board.
Collaboration is key.
And examiners shouldn't be telling banks what kind of software to use or how to keep their records.
It's not about dictating those specifics.
The best way to get management to fix things is to focus on those big problems and suggest solutions, those smaller problems. They can talk about those with management and make verbal recommendations.
But document them in the work papers.
And it's important to remember that when they're looking at a single control, or even the lack of a control, they need to think about it in the context of the other related controls.
Looking at the bigger picture. Now, what about those troubled banks
Those that haven't had audits done by an independent accountant.
and have some issues?
Like what?
Things like bad internal controls or audit procedures. A board of directors that doesn't know enough about internal controls, evidence of insider abuse, suspected fraud, or criminal activity, the possibility of those directors being held responsible for losses, situations where they need to do direct verification or questionable transactions with affiliates.
So a lot of potential problems.
If they see an institution like that, they should think about requiring an audit.
Or having an independent party perform some specific audit procedures.
They can include that in an administrative order.
And each situation is different, so they need to think about what type of audit program is best, and they need to work with lawyers to make sure that requirement in the order is legal.
So it's not a simple process.
And if they include a requirement for an audit or procedures in an order,
What else needs to be in there?
it should say that the bank needs to send those reports to the regional office right away, and they need to let the regional office know about any meetings where they're talking about the findings.
Staying in communication with those regulators. Now, what about those management responsibilities? We talked about how checking out internal control programs is a big part of exams.
How do examiners typically go about assessing those controls?
It sounds like a pretty complex process.
They can usually get a good sense of how things are by looking at the overall structure of those audit and control programs, those monitoring procedures and reporting mechanisms, looking at the audit reports and testing a few controls or procedures.
So, using a variety of methods.
And they should try to find and fix those systemic weaknesses.
Those underlying problems that are causing the breakdown.
And there might be serious weaknesses if management isn't doing some key things.
Like?
Clearly defining responsibilities, standardizing those risk assessments, separating duties, making sure there are enough qualified audit staff, and reviewing and responding to those audit reports.
Those are the basics.
And sometimes they might need to do more extensive testing.
Based on the situation.
Now, there are some procedures that can help uncover those errors or fraud or insider abuse.
But they don't need to use those at every exam.
And if they think those fraud-related procedures are necessary,
They should talk to the regional office.
okay, let's go through those techniques the manual talks about.
Starting with those account reconcilements. What are those?
When examiners prepare those reconcilements,
For those asset, liability, and capital accounts.
it helps them make sure those entries are right and those subsidiary records match the general ledger.
Checking the math.
Now, direct verification, it's usually the bank that does this. But sometimes examiners might need to confirm those balances directly with the customer.
Going straight to the source.
The bank should do this whenever possible, and if the FDIC is going to do it, they need approval.
From the regional director.
And there are procedures for those examiner-initiated verifications in the Commercial Bank Examination Manual.
So a clear process for them to follow.
And they might also do some extra work when they're reviewing loans.
Especially if there are signs of problems with credit administration or possible fraud.
And they can take steps to investigate those deposit accounts.
Looking for improper activity.
Things like reviewing signature cards, looking at those new account reports, or examining checks.
Following the paper trail.
When they're looking at those correspondent accounts,
Accounts at other banks.
they might send out confirmations.
Getting that verification from the other bank.
They should also check those tellers' daily cash records and those items they handle.
Making sure everything is in order.
And they should look at those suspense accounts.
For anything unusual.
When they're testing interest calculations, they should use tools to verify the accuracy.
Of those calculations for loans and deposits.
And when they're verifying those income account debits, they should look at the documentation to make sure it's all authorized. And for those expenses, they should make sure they're legitimate and approved.
So making sure the money is being spent properly.
When they're comparing the interest paid on deposits to those control accounts, they should use a predetermined rates and test some accounts to make sure it's right.
Another accuracy check.
And they should investigate anything unusual in those general ledger accounts,
Along with those reversing or correcting entries.
trying to understand what's going on. They should look for any big changes in the assets or liabilities from one exam to the next.
So those significant fluctuations.
And they should look closely at those out-of-territory loans, any rapid growth in loans, and any connections between those new loans and new CDs.
So being aware of those potentially risky practices.
And they can use the Secretary of State websites to get information about corporate structures, officers, and directors.
To see if there are any connections they didn't know about.
That might be risky for the institution now. Even with the best techniques, you might not catch every instance of fraud.
It's not a perfect system.
And those smaller institutions, they might be more vulnerable.
Especially if they don't have a dedicated internal audit staff.
So examiners need to be really careful and use their judgment about when those extra procedures are necessary,
Okay, let's talk about some other control issues.
like those related to technology.
Information technology is a big one.
Part 364, it requires institutions to have those information security programs.
To protect customer information.
And the board or a committee of the board, they have to approve that program, oversee it, assign someone to implement it, and review management's reports about it.
So it's a board responsibility.
And institutions have to do those IT risk assessments.
And understand those risks to their system.
And examiners, they should use the FFIEC IT examination handbooks.
When they're reviewing those systems and controls.
Those handbooks are a great resource.
What about management information systems?
MIS?
For those-
It's that process that gives the institution the information they need to run things.
But it's computer-based.
It's really important for managing risk, especially for those larger institutions.
So having the right information at the right time.
For it to be effective, that information has to be timely, accurate, complete, consistent, and relevant.
Making sure it's actually useful.
And examiners should look at all of those things when they're reviewing an institution's MIS to make sure it's giving management what they need to make good decisions.
Making sure it's doing its job.
Okay.
And payment systems.
Another important area.
There's always some risk with those payment systems.
Credit risk, liquidity risk, operational risk, legal risk. Those are just a few. And examiners need to make sure the institution's controls are strong enough to handle those risks.
Based on what they're offering.
And the handbooks.
Those FFIEC IT examination handbooks.
They have those detailed procedures.
Okay, so we've covered a lot of ground here today.
We talked about internal controls, those audit programs, common audit procedures, and even touched on some related control issues.
It's a lot to take in, but hopefully this deep dive's been helpful.
It's all about equipping you as examiners with the knowledge you need to ensure the safety and soundness of those financial institutions.
So keep learning, keep asking questions, and keep striving for excellence in your work as examiners.
We appreciate you joining us.
And we'll see you next time for another deep dive.